Welcome back. In the first half, we analyzed two real-world failures of Keynesian economics and its fundamental differences from the Austrian School. We reached a disturbing conclusion. Instead of healing the economy, continued government stimulus may be preventing it from self-repair, exacerbating the problems. Today, we'll address an even more pointed question. If Keynesianism is so flawed in economics, why has it remained so enduring among policymakers worldwide? The answer may have nothing to do with sophisticated economic theory, but with basic human nature. Keynesianism's enduring popularity stems not from its economic validity, but from its political perfection. It provides politicians with a coveted weapon, a passport to the promise of a free lunch. Imagine you're a politician facing an election. Faced with economic hardship, you have two choices. Option A, the Austrian prescription: tell voters we need a painful period of adjustment, tightening our belts, letting unhealthy businesses go bankrupt, and cutting government spending to lay the foundation for healthy future growth. Option B, the Keynesian prescription: tell voters not to worry. The government has a solution. We will create jobs, stimulate the economy, and ensure everyone lives a good life through tax cuts, subsidies, and infrastructure investment. As for where the money will come from, we can borrow now and leave the problem for the future. Which would you choose? The answer is self-evident. Keynesianism perfectly caters to the weaknesses of human nature. We all prefer instant gratification and dislike immediate pain. It allows politicians to play the role of savior, using seemingly costless means to buy votes and support. The resulting massive debt and long-term economic structural distortions will be a problem for the next government and even the next generation. Therefore, MMT, modern monetary theory, is more of a political propaganda tool than an economic theory. It cloaks irresponsible fiscal policy in a veneer of science, making the dangerous idea that deficits don't matter seem plausible. This is the real reason why Keynesianism has been able to hold the reins of global central banks and governments for over half a century. It's not an economic issue, it's a political one. However, even the grandest feast must eventually come to an end. Prosperity fueled by debt and money printing will eventually face a reckoning. And the United States in 2025 stands on the eve of that day of reckoning. The current Trump administration seems to recognize the severity of the problem. They are taking an unprecedented gamble, attempting to break this vicious cycle with a non-Keynesian approach. Their core strategy is to stimulate private investment through massive tax cuts, deregulation, and trade protectionism, attracting manufacturing back to the U.S. economy and reigniting the U.S. economy's endogenous growth drivers. This is essentially a reversal of decades of policy. But where will this gamble lead the United States and indeed the world? We can foresee three possible development paths. Path 1. The most optimistic scenario, a Reagan-style revival. This is the outcome the Trump administration hopes for. Just like President Reagan's supply-side reforms of the 1980s, tax cuts and deregulation have greatly stimulated business vitality and ushered in a long period of economic prosperity. If this scenario were to repeat itself, the United States might indeed be able to gradually digest its massive debt stock by expanding the economic pie. However, this path would be extremely difficult to achieve, as it would require a miraculous leap in productivity. Path 2. The most chaotic possibility, a stagflationary quagmire. This is a more realistic and more dangerous possibility. On the one hand, tariffs and the reshoring of manufacturing will inevitably drive up the cost of goods and services, leading to persistently high inflation. On the other hand, the disruption of the efficient global supply chains built over decades and the crowding out effect of massive debt on private investment will continue to drag down real economic growth. Ultimately, the United States could fall into the stagflationary quagmire of high inflation and low growth similar to that of the 1970s. Path 3. The most painful outcome, debt crisis and hard landing. If economic growth fails to take off and the debt pile continues to grow, market patience will eventually run out. We could then see a revolt by the bond market boxers, investors beginning to sell off U.S. treasuries en masse, sending long-term interest rates soaring. This would detonate the debt mines lurking in the financial system, triggering a financial crisis even more severe than the one in 2008. This would be a painful, hard landing, the long-delayed, yet ultimately inevitable, market clearing that Hayek envisioned. No matter which path the future ultimately takes, one core fact is clear. We are in an era of great uncertainty. The old rules are failing, and the long-term purchasing power of our fiat currencies is facing unprecedented threats. So, how can ordinary investors protect their wealth in this profound upheaval? Here are some practical suggestions. 1. Re-examine the notion that cash is king. In an era when governments have strong incentives to dilute the value of their currencies, holding large amounts of cash and low-interest government bonds may no longer be a safe haven. Instead, it could mean allowing wealth to be eroded by inflation. 2. Embrace scarcity. Capital will flow to assets that cannot be easily printed. These assets fall into two categories. Tangible, scarce assets, such as prime real estate and precious metals that retain their value in an inflationary environment. And intangible, scarce assets, namely, equity in high-quality companies with strong moats, pricing power, and the ability to consistently generate free cash flow. 3. Be wary of pure story stocks. Improper investments that were hyped up during the low-interest rate era, based solely on concepts but without profitability, will face their most severe test when interest rates return to normal. We need to pay greater attention to a company's true profitability and the health of its balance sheet. 4. Maintain a global perspective. Despite ongoing deglobalization, concentrating all assets in a single country or currency is becoming increasingly risky. A moderate global asset allocation is essential for risk diversification. We are experiencing a profound economic paradigm shift that will impact generations. The Keynesian promise of an economic utopia of unlimited overdrafts and no pain has proven to be an illusion. The day of reckoning may be delayed, but it will never be absent. Amidst this profound change, it is crucial to maintain a clear mindset, not be seduced by artificial short-term prosperity, and proactively build a sturdy harbor for your wealth that can withstand future storms. The above is my personal opinion only, not investment advice. Thank you for your company.